Good morning. It's Tuesday morning here, and I'm just getting ready to start my day. This is my fourth video uh, in relation to buying a home in Nova Scotia. And I was thinking I would go through some of the ins and outs of financing. Being a mortgage broker, of course, you know, I bring that knowledge to the table when you're looking to buy a property, and the whole process of arranging financing can be sometimes an effort and frustration. There's so many different criteria that the average person, you don't buy and sell a house every day, or it's an ever-changing landscape. What it takes to get a mortgage today as compared to, last year, 5 years ago, maybe the last time you did a transaction, a lot of the rules may have changed. One of the things that's happened lately, in the last 4 years, the federal government has tightened credit 7 times. Each change has basically taken a few more buyers out of the market, and other than those busy markets in Alberta or Toronto or Vancouver, the rest of Canada is pretty much going through quite a credit crunch, right? So in most smaller communities, it's definitely become a buyer's market just because there's not as many buyers in the marketplace. So sellers are competing for those fewer buyers. But what happens, you go to the bank and you get pre-approved for a mortgage, right? They say they take all your information, your income. They qualify you usually. Uh, One of the ways is they will allow you to pay 40% of your gross income out in total payments. So basically, 40%. If you made 30,000 a year, 40% is 12,000. Divide by 12. Your total payments can't surpass 1,000 a month. Every company's a little different on their guidelines on that. Some may go to 42. It depends on your job security. An underwriter looks at the whole thing and assesses the risk, right, and decides what they're willing to do, right. If you're high ratio, the high ratio means anything over 80% has to be insured. That's law in Canada. The banks aren't allowed to lend over 80% of the purchase price or the appraised value, whichever is least, um, unless the loan is insured. And that merely means a third party insures that loan for the lender. So if for some reason the loan's not paid, the insurance will pay the loan out. So our banking system loves insuring the loans because it eliminates the risk for them, right? CMHC is the biggest provider of that insurance. It's one of the things that the governments had done right over the years until recently. CMHC made housing accessible to more Canadians by providing this insurance. There's other companies, private companies that are doing that. Genworth is one that seems to do a great job picking up a lot of the slack as CMHC reduces the amount of business they do. But this insurance protects the banks if you don't pay the loan, basically. So that's high ratio, right? Anything over 80%. If you have 20% down, the banks can do 80% in-house, right? They don't have to involve that insurer. Now, lots of times, approving you just means that you can afford to borrow this much money. The approval process, first of all, again, if you're high ratio, they have to approve you, right? Then, of course, insurer has to approve you, right? And insurer won't do that until you find a property you want and they're processing the application. Uh, but the third level of approval is, of course, the property, right? If your property is in a good resale area and everything looks good, right, that's fine, they'll approve it. But if you're buying something, in a slower resale or whatever, the lender still may want to insure that because they don't trust the market in the location that you're buying, so they want to have insurance in place. So you go through, first you get pre-approved, and then you think, okay, I can go home shopping. Then you find the property you want, and then they process the application, and then they approve the whole parcel, and you get your mortgage and you buy your property, right? But the property becomes an important part of the equation because the approval process is the lender can on a high ratio, right? They can do up to 95% of the purchase price or the appraised value, whichever is least. So if the appraised value is less than what you paid for it, that means, let's say you buy a property for 200,000 and the appraisal comes in at 180,000, they can only do 95% of the 180,000. So that shortfall you would have to cover. And of course, right away you'd say, well, maybe I'm paying too much or whatever, right? But the appraisal process, right? When the bank approves financing, they may approve it subject to an appraisal. The appraiser comes out, right? The appraiser is a third party, independent in most cases, who the bank has hired, right? Even though they may make you pay for it, is someone that they approve, that's on their list, and the appraiser comes out and determines the market value of that property. They may or may not know what you paid for it. The way the appraisal process works, the appraiser on a residential appraisal, they have two approaches to value: cost and market. So the first thing they do is figure out what it would cost to replace what you're buying. They factor in depreciation, right? And then they come up with, well, here's a value from the cost approach. Then the next thing they do is they find three comparable properties that have sold within a certain period of time. The lenders all have usually it's 90 days. They have to find those comparable sales, and that can be a challenge for the appraiser in a slower market, right? Because there may not be good comparables in the last 90 days, and then he can, if he or she, as the case may be, he goes further back and finds more, and then he'll, on the report, he'll do an explanation as there wasn't that many accurate comparables within 90 days, and I had to go a little further back, or I may have had to go outside that local area and compare to other houses in order to come up with an accurate estimate of value from the market data approach, right? So, and the way the appraiser does that, he finds three properties and he compares the one that you're buying to those three properties, right? And the appraisal form is made up of there's one column with all the features of the property you're buying, and then there's three columns for those comparable sales. And then he'll, across those columns, he'll, this lot's 2 acres, that lot's 1 acre, I might minus that a little bit. The house you're buying is 1,200 square feet, the comparable is 1,000 square feet. I'd probably give you a plus for that, right? And so these three columns, at the bottom of the three columns, he does a summary, and based on those three, after adjusting compared to the one he's appraising or she's appraising, he'll come up with a value based on comparing to those three properties. So then you have your two values, replacement cost and market data, and from that information, the appraiser comes up with, in my opinion, this property is worth this much money. Right now, it's if you pay 200,000 for the property and he appraises it at 205 or 210, there's no problem. If he appraises it, at 198 or something like that, that's usually not a major problem. They may want you to put a little more down or something, because they'll lend you 95% of the 198, right? But if it's 180 and it's $20,000 difference, they'll say we'll give you 95% of the 180, and you have to come up with the difference. So therefore, you can run into issues in regards to that appraisal, right? Not supporting the value that you're paying for the property. The other equation that you run into, especially I deal with a lot of rural property, and if you get into acreage, right, most of the residential lenders they have restrictions. For example, CMHC, I just did an appraisal for CMHC in the country, and yeah, there it was, I think it was 28 acres, and there was a barn and a big machine shed and attached garage with a house, right? So CMHC's instructions were I could only use 5 acres and no outbuildings, right? So right away, when doing that appraisal, I couldn't use the extra acreage, I couldn't use the barn, and I couldn't use the machine shed. There was an attached garage, and that was okay. They'll allow one garage, right? So therefore, whatever the price the people had negotiated for the property, when I did the appraisal, I couldn't include those extra assets. So there's a good chance the appraisal might have been came in less than they paid because I couldn't include everything they were buying, right? So when you run into those circumstances, it's important to understand the process, because it doesn't mean what you're buying isn't worth what you're paying for it. It just means that the appraiser couldn't utilize everything that was there in the appraised value based on the lender's own particular policies, and they're all somewhat different. Some banks will allow up to 10 acres. Some banks will allow up to 15 acres, right? And again, like CMHC's instructions on this one were 5 acres. There's variables in there, right? And so you may get a turn down on your financing, and it's important to make sure you're clear on why there was a turn down. I know some years back, one of the things that we do in the mortgage broker part of our business is we're always looking for companies that are more comfortable with rural property, because we deal with a lot of rural property. And I know some years back, I think it was Concentra, they would allow up to 80 acres into high ratio, right, which was a great benefit to us because we have so many properties that have a lot of acreage and outbuildings. And I deal with, I think I mentioned before, I deal with a lot of horse people, and you can put a lot of money into your barn, your riding rink, and all those things, and you're increasing the value of your property. But if the lender won't allow that to be used when it's appraised for financing, of course, that's a hurdle that has to be overcome. And that's why it's important that your realtor understands all those things when you're selling a unique property, right? When you get into rural real estate, every property is different, and the sources for rural property, when you get into that type of property, you have farm credit, right, which has a part-time farm program. And of course, in Nova Scotia, we have the Nova Scotia Farm Loan Board for working farms, right? But that recreational farm is kind of left out of the equation. I think, most of the banks haven't really come up with anything to my knowledge. I know I was approached one time by someone from the TD that said they had a program now that they could do up to 90% on rural property, but I haven't utilized that a lot. But they may have something, but I'm not that familiar with it. But anyways, those are some of the ins and outs, understanding how it all works, right? So when you walk into the bank and they say you're approved, go out and buy a $200,000 house, right? Remember that that just doesn't mean you carte blanche come out and I can buy your property, be careful. There's steps to go through to make sure the property qualifies for that particular lender's guidelines. Anyways, that's my talk for this morning. Hopefully you have a great week ahead of you, and thanks a lot, and we'll talk later.